On today's episode of The Report, we're going to look back at the Forum, our inaugural conference we just wrapped up about a week and a half ago. NMHC recently released their list of the top 50 owners, managers, and developers. Blackstone today announced they're taking one of the few remaining multifamily REITs, Air Communities, private. There's been a huge jump in multifamily delinquent loans. There's a surprising left-right alliance wanting more apartments in the suburbs. Two of the largest players in the credit card space have announced they're reducing or getting rid of fees. We're going to bring our CRO in for a special guest segment on the big settlement reached with the National Association of Realtors, what that could mean to the standard 6% commission, and whether there's any ties back to multifamily. And finally, the huge jump in insurance premiums that have been going on for years. There are now some real numbers behind those. Enjoy. Welcome to the April report. Very excited to be coming about a week and a half after our first ever forum. I know, Tyler, you had a week off in Japan. I'm sure you've had some thoughts since about our inaugural event, but a quick recap for those who weren't there. We had 100 of the top leaders in our industry show up, 49 companies represented, a ton of folks talking about the community that was started there, learning new things about centralization, taking back lessons learned, best practices, things to avoid that were shared with them in very candid conversations, being able to take those back to their companies and move forward from it. So we were very excited with how it came out. The feedback has been incredible thus far, but Tyler, a week out, curious what your takeaways are.
I think the most exciting part for us is that people stopped referring to it as the funnel forum and rather just the forum. And that's, we chose that name intentionally. Forum meaning venue, meaning, place to dialogue, important ideas. And that really happened. And so I think I love this industry, and it's such a cool moment in time in this industry where there are real challenges, but it was phenomenal. So yeah, the community effect that happened at Forum was exciting. And now the number one thing everyone's asking that attended is, when are we going to do it next year? So super excited for that.
And if you're looking for the answer on when next year's forum is, we're still nailing that down, but I would cross off mid-April-ish next year, location TBD. Let's jump next to the NMHC top 50 list. They just came out last week. Shameless plug, 10 of the 50 largest managers are on our CRM. 8 of the 50 largest owners are on our CRM. Congrats to everyone who made the list. Some of the bigger changes that have been in play for a couple of years seem to be around third-party managers taking up a bigger portion of those top 50 lists, and an even smaller number of the bigger ones doing it. So, Tyler, any other big takeaways from this year's list?
I think that is the number one trend. Our friend Dom has been talking about that for the last several years, the share of the market, and particularly the larger managers. Until we get a cease and desist, I'm going to claim that we came up with the term mega managers. And this year's NMHC list validated that concept. The top 3 managers, which were Greystar, Asset, and RPM, all grew by over 75,000 units each. Just insane growth. If you were at 75,000 units as an owner, I think that puts you in the top 10. And those 3 managers each grew by that number. In particular, another huge highlight making a lot of news, Greystar was number 1 on 3 lists. So they went from number 2 on the owner list. And just a few years ago, Greystar only owned about 30,000. Now they own over 100,000. They passed MAA for number 1 on the list. MAA, great company as well out of Memphis, funnel customer. And then Greystar is number 1 developer as well. And they were number 3, I think, on the builder list. So just, real juggernaut, and congratulations to them on the success across the board. And that did not include the Wood acquisition, obviously. So that happened after. So I clearly this acceleration towards mega managers is here to stay. And we'll talk more in the future about what that means. But, congratulations to everybody on the list.
Another breaking news piece today, Blackstone just announced they're going to be taking one of the few remaining multifamily REITs, Air Communities, private in a $10 billion deal. In January, they agreed to acquire Tricon Residential for $3.5 billion. This is Blackstone again. The shares of the REIT jumped around 23%. That's just today. This thing just got announced. So in our world, our share of the REIT market just went up. But Tyler, what else do you think about this news?
Yeah, no, we have three of the now, I believe, five public REITs that are out there. For those who don't know, AIR and Aimco used to be one and the same. You know, UDR, Aimco were kind of the two big Denver REITs. They're both known for a lot of innovative approaches early on with revenue management and centralization. So big news to see one of those prominent names in our industry go private. For those who don't know, Blackstone is the world's largest alternative asset manager, $1 trillion of assets under management. And so on a dollar basis, this is a fairly small investment for them, but it's a big investment in that it's their biggest ever private real estate deal. So taking public to private $10 billion investment. Blackstone has LiveCore, of course, their asset management arm. They also, in the past, you mentioned Tricon Canadian operator. They've done preferred. They own Beam, largest apartment community in New York City. So not clear exactly. Nobody knows exactly how Blackstone will manage this portfolio. They obviously, with their asset management on LiveCore, leverage a lot of large third-party managers like BH, who's a funnel customer. What I think this signals, the subcontext for me, the big headline is, largest alternative asset manager in the world made their biggest ever real estate acquisition. And that's a sign of the times in that the markets are starting to look better. And in particular, I think this is the good, bad news that we've been talking about. The lack of supply 2-3 years out from now, that's starting to be penciled into deals. And so when you're making an acquisition of assets in multifamily, for the last couple of years, you didn't know where rates were going to be and you knew supply was coming. Well, now it looks like rates are coming down. It looks like supply, this surplus of supply, and obviously on our show, we like to talk about it's the right sizing of supply because we need more units in this country. But 2-3 years out from now, due to the number of starts that are down, it looks pretty rosy for asset managers. It looks like rents are going to be growing again. And we think healthy rent growth is a good thing, hopefully not overinflated rent growth. That's a bad thing for everybody. But at any rate, big news and further acceleration of what we were talking about, which is the third-party management industry seems to be accelerating. The REITs of the world. And fun fact, I did not know this, but not that long ago, I learned this at Forum. There were REITs that were 200,000 units. I think Equity Residential was near 200,000 units at one point in time. So clearly now that's not the case. MAA is the largest REIT at about 100,000 units, but almost all the REITs have been about the same size for a while. Phenomenal businesses. But in terms of growth and management consolidation, clearly we're seeing a shift towards these large management organizations.
Globe Street had an article last week. Delinquent multifamily loans are becoming a problem for banks. Past due loans rose 81% year over year, highest total since the second quarter of 2013 when delinquent multifamily loans were around 3.7 billion. What does this mean for operators, Tyler?
So I think the last piece of news is important, Alex. If we tie these two stories together, when delinquency really gets problematic is when the markets aren't selling, right? And because if you have an asset that's underwater, but there's no buyers, your options are very limited. And that's when you see obviously things go into delinquency and really down the paths where there's real pain in the economy. And I think if we look at the commercial real estate sector, which has been way harder hit than, and by commercial, I'm speaking specifically like office as compared to multifamily, occupancy is way down in office. In many markets, it's sub 50%, but even 60% in places, prime real estate for office. But there's not been a huge wave of delinquent loans. And the main reason for that is they've been able to, before these loans all come to maturity, they've been able to extend and renegotiate different deals. And going back to what I said, where, you see Blackstone making this massive investment in real estate, when people are able to look into the future and see a bright outcome for those assets, there's always the ability to refinance. And there's also the ability to potentially do deals and sell assets at a discount. And so while it's not great news that there's delinquent debt, it's certainly not a shock to anybody. We've all known that given the increase in supply, decrease in demand, rent growth stalling, there were a lot of deals that weren't going to pencil anymore. So there's been very specific stories that we've seen. Even, WeWork, the founder of WeWork, started a company called Flow a couple of years ago. There's stories about how Flow, those deals that they have aren't, they're not hitting their pro forma. And so there's some bad debt. So anyway, long story short, I believe that the optimism for rent growth 2 to 3 years out means that a lot of these deals, especially those that are coming up for maturity, will get renegotiated and they'll get extended out into time frames that allow them to perform.
I'm always curious when the word pencil is going to go out of vogue. Like, are people still using pencils for these things?
Yeah, that's a good point. I think that's obviously in the vernacular of, trying to make it work, but it's not that, wet ink pro forma yet.
Pencil, yeah, it's erasable. So are spreadsheets, though. Let's talk about the New York Times piece on the surprising left-right alliance that wants more apartments in suburbs. I'm a sucker for anything that bridges the very divisive divide we have in this country. So the article went on to talk about how legislators on both the left and the right are really working to add duplexes and more multifamily housing to traditionally single-family neighborhoods. Clearly, an election year, things like this are going to become fodder and interesting stories for people to jump on. We at Funnel believe in creating spaces for healthy debate. We think more housing benefits everyone, but curious why this issue may be getting more attention right now and why we're seeing this divide being crossed by both sides around housing in suburbs.
Yeah, it is great news. It is absolutely great news. And I think it is much better news than the easy political points that can be scored by, rent control and housing increase caps, by banning software. There's a lot of different things that have been discussed in this industry that are net negative outcomes for renters, for housing affordability. And the one that everybody should universally agree upon is increased housing supply. In particular, where this is exciting, Alex, as you mentioned, kind of the concept of single family neighborhoods, SFR, BTR, we talk about in this industry, because the number one impediment, and will remain this, so I'm happy to see politically that we're targeting this. The number one impediment to housing supply is NIMBYism. For those who don't understand what that is, not in my backyard. And we're all prone to it, right? When you purchase an asset, you think, well, I don't want, them building low income housing across the street from me. That's going to hurt my home values, which is just the mindset, and not only the mindset, but frankly, the political system that's been established in our country, and particularly in cities, HOAs, where you just can't get housing supply built. And so anything that targets and incentivizes development is a net positive. And I think it gets the most obvious example. You mentioned I was just out of the country. Whenever I go out of the country, I try and look at rental housing, try and look at housing in general. And what America has done so well is provide high quality housing at an affordable price compared to our peers. And even just, Europe, Toronto, Vancouver, just over the border. Those are markets where there has been a real supply constraint on rental housing being built. And that creates just out of control rent growth in an unsustainable way. So yeah, I'm all for any party, red, blue, purple, that is going to put incentives in place for developers and renters to get more supply into the market, including, and I think one thing here, there's been a lot of articles written about how the housing data that's been used to determine inflation has factored. One of the reasons that hasn't shown cooling in the housing market, in multifamily, we've seen cooling. We've seen rent growth kind of stall in many markets, but that's just apartments. That's multifamily. If you go on Zillow right now and look for a single family rental in your neighborhood of choice, I guarantee you it's more than your mortgage. They are insanely expensive to find single family rentals in kind of the suburbs. And so I think there's a huge need for BTR and rentable SFR.
I'm excited to introduce, if you hadn't heard of it, a new acronym, which is YIMBYism. That's a real thing. Yes, in my backyard. So
yeah, and
hopefully
you can get your free YIMBY shirt from Funnel if you subscribe to this podcast, coming out in black and pink.
There was another great article in the Times about credit card swipe fees going down and whether that's going to drag points and loyalty with them. Visa and MasterCard recently announced they're going to greatly reduce the fees they charge to merchants. Those fees generally fund those reports and the free travel we all love and rely on for a lot of our trips and getting something out of nothing. So this move feels like it could impact future loyalty in any of those charges that occur, but loyalty is something we've been talking about in multifamily. I'm curious what your take on this is.
Yeah, so I think there's a couple of things to unpack here. I want to go to the first one without naming names. I recently had a conversation with a leader of one of the largest prop tech companies in the world in our space, and we were talking about this, and he said something very astute. He said, when it comes to payments and fees, it's a race to zero. And I think anybody who doesn't recognize that the ability to monetize. So I'm talking specifically about processing fees that a lot of technology companies, not just in multifamily, but specifically in multifamily, have built their whole business around, right? We're going to offer relatively low cost software because we can make a ton of money charging fees to renters to swipe their cards or put their card numbers in online. That is not a long-term business strategy. And frankly, whether it's through legislation or competition, hopefully more of the latter, those are going to be a thing of the past. Now, so to segue that into your second point, we've talked a lot about, we're big fans of tools built to designed in our industry around loyalty, rewards. The two big rewards tools that we've talked about, one is Stake. We have a shared investor. They have a certain approach to rewards points, and I know there's others. The big one that a lot of our customers use for rewards is the Built credit card. And both of those are designed for rewards, which, as you said, can create loyalty. They're not designed specifically for multifamily brand loyalty, but if I spend money on rent, in theory, I'm building points that then I can use for neighborhood rewards, and therefore I feel some level of loyalty to both the card and my rent. That, as you said, is in question, and so this has been happening over time, where both, again, through competition and legislation, there's been downward pressure on those points. I do think it's a net positive. Again, I'm a fan of the different rewards tools that are out there, and I'm sure they'll figure out a way to make this work for them. But, it's a little bit like here in Florida, in the South, we have a grocery store called Publix, and it's very popular if you're from the South, and they're known for their BOGO. They're buy one, get one only. And you realize you're not really saving money on the buy one, get one, but it's a phenomenal marketing spend. And so, like you said, Alex, we know when we swipe those cards, I'm building up my points, I'm going to be able to pay for the vacation. There's no free lunch, right? Those fees are finding their way into the cost of things we're paying for every single day. And those of us on the multifamily side know that's true of our software and the swipe charges that come with paying rent. And so the more we can provide transparency and competition around those things, the better. So not sure exactly where it nets out, but again, I'm happy to see us moving in a direction that I believe is more pro-consumer and pro-transparency.
For this next story, I want to bring in our CRO, Johnny Hanna, and you'll hear why very quickly. A couple of weeks ago, the National Association of Realtors reached a nationwide settlement that could fundamentally change the way that agents are compensated in home sales. Typically 5 to 6%, it's shared usually by your buyer and seller agent. Under this settlement, commissions will be subject to more negotiation, which could lower the cost of buying and selling a home. I know if I had $1 for every person I know who sold a house and told me their agent had earned that commission, I'd probably be in debt. But Johnny, you co-founded a company called Howe a few years ago. I'd love to hear what this means to you.
Yeah, happy to chime in. And there are great agents out there, Alex. So I have heard people that have earned their commission, but yeah, my whole company was set up to lower the fees and make it more palatable for people to buy homes without having to pay an extra 20, 30,000 in commissions. So yeah, this settlement, I think it was going to be big. It was potentially a $5 billion settlement. I think the NAR got off the hook only having to pay $418 million over the next 4 years. And one of the things they agreed to was that the seller agent could no longer list how much they're paying the buyer agent on the MLS. And the problem was that buyer agents would look at homes on the MLS and they could sort, in many cases, by how much commission they would get paid. So they would take and steer their buyers to homes that were paying upwards of 3% commission versus just taking their clients to homes that fit their criteria. So I definitely think it's a big settlement, but the Department of Justice just came out over the weekend. They're going to continue to probe with the National Association of Realtors, and I think rightfully so. There's a lot more that needs to be looked into, a lot more that needs to change. These settlement changes won't happen till July, but the Department of Justice might postpone things as they find out a little bit more.
So, Johnny, my question for you, us in the apartment industry, the DOJ, and there's been a lot of litigation and lawsuits around the same kind of question of housing affordability. I've heard for years, being in the prop tech space, and I've never worked like you have as closely with NAR, but that, I think most of us here in multifamily think it's a stretch to think there's anything close to approaching a monopoly. Certainly it feels like the DOJ is leaning in and saying, hey, this is monopolistic behavior, and the same with these lawsuits. The goal, of course, is to try and create more competition and more housing affordability. So like you said, this is just the beginning of the story, but if that's the intent, is that at least in terms of house affordability, home purchase prices, do you think this settlement, this news is a step in the right direction, or are we not there yet?
I don't think we're there yet. I think the only step in the right direction is it's getting a lot of headlines and it's causing consumers to question, what am I paying? Why am I paying this? I think that's the benefit for consumers, but I don't think things are really going to change dramatically. And I think from housing affordability standpoint, there are a lot of arguments that these commissions kept prices high.
Yeah. Well, we are, watching closely, obviously, in multifamily. I think you're right. Supply and demand are the number one factors that come to pricing. And obviously all of us in multifamily know there's a huge supply coming to the market of multifamily units, but we've talked a lot on this podcast, in a couple of years that could change. So just curious your take, as knowing the economy of single family homes as you do, if interest rates come down, I imagine that is that what's going to get the housing market going again? Or are there any other factors along with this, changes to the real estate commission model?
Yeah, I think it'll help. If interest rates come down, it'll help. More people will be buying homes. People have just been priced out. But I definitely think our industry here in the apartment industry, we're going to be pretty safe for a while to come. I think the thing that we probably need to watch out for is if more lawsuits continue, which I think they will, and if the DOJ makes additional changes, the NAR will be hurt more as an organization. And I think where they've helped our industry is when it comes to lobbying. Like they put a lot of effort into lobbying against rent control, which I think helps the multifamily industry. So we might need to up our game on the lobbying front.
Let's move on to the final story. There's a Globe Street piece on just the rise in insurance premiums and how that's driving up expenses overall for apartment operators. This surprised me. We all know insurance rates have gone up both for ourselves and certainly in the commercial space and multifamily. Insurance costs per unit rose an average of 27% from January last year to January of this year. And if you look from 2018, insurance rates have risen 129% nationally. That was 6 years ago, to an average of $636 per unit. We've talked about insurance before on the podcast. Seems to be a topic that isn't going away. Natural disasters are not going away. Tyler, what else do you make of this?
Well, I'm going to give a shout out. We were, Alex, preparing for our TAA panel. Anybody who's going to be at the TAA in San Antonio later this month, please come listen to our session. Of BH, Christy Weinstein had a great comment. She was talking about centralization and cost management. And she said, when it comes to insurance, that's just something that's out of our control. And so all of us as operators wish we could wave a magic wand and get insurance under control, but you just can't. And so we're left to work with what we can manage, which is labor expenses and operational efficiencies. And so while, of course, I'm not a fan of anything that makes our industry, pay extra premiums for less value, it has created a sense of urgency in our industry, these insurance premiums around operational efficiency, right? When zero interest rate environment and 20% rent growth, we all know led to some apathy. It led to a lot of folks just saying, well, I'm sure I could operate more efficiently, but I'm doing pretty well. And I believe the net benefit of operational efficiencies is a better consumer experience, better, more sustainable staffing models in our industry, better, bigger, better paying jobs in our industry. So all that being said, again, it's uncontrollable for all of us because, like you said, natural disasters, we're recording this and there's an eclipse going on. I know that's not a natural disaster, but it's one of those things that's outside of our control. And so, I am very encouraged by the number of operators who are taking this challenge, just, uncontrollable, and making with that a better operating environment for their portfolios and for their renters.
Big shout out to Christy for that controllable versus non-controllable. I know our producer already jotted that down as a great way to talk about what we can and can't do things about. So thank you for this, Tyler. We will catch everyone on next month's report.
Thank you.